Hello, everyone, and welcome to this week's NASDAQ Dorsey Wright podcast. Today is actually September the 15th, but this will be published on the 16th. And today I'm personally excited to have a very special guest on our podcast. Many of you may be familiar with her, as she does carry quite the name and the brand in the industry, especially within the technical world. And we are thrilled to have Katie Stockton on with us on the podcast. So, Katie, pleasure as always seeing you, and thank you for joining us today.
You as well, David. It's really good to be with you guys. I'm glad you're doing this.
Yeah, it's these are typically something for us where we like to communicate our thoughts on what we're seeing in the market over the past week and things like that. But also our effort in inviting you on today is to get a slightly different opinion than what we often say here at Dorsey Wright, to give our clients something a little bit different. So first, I wanted to dive in for those the few, admittedly, that may not be familiar with you. You want to give yourself a little bit of background about yourself, and I believe there's one cool fact that I think most might find neat as well.
Yes, you're preempting it nicely there. So Katie Stockton, I'm a CMT or Chartered Market Technician. I received that designation back in 2001. So you can see that I've been doing this for a pretty long time. And my career began at Dorsey Wright. So this is way back when I went to University of Richmond. And I had an interest always in finance. And yet I don't know that I was set in my ways yet until I was exposed to Dorsey Wright during an internship that turned into sort of a part-time job. I was there over the course of 2 years, hand charting the point and figures for Tommy and Sue, and it was just amazing. It was really amazing, and Tammy, of course, experience just to grow up with that in a way in terms of the early stages of my career. I learned, most importantly, that the best way to stay close to security is by hand charting it. Of course, I rarely ever do that now. So it's nearly impossible, but we do have more capacity, at least now, with the software that is available to us. But it was a really formative time, of course, in my career, and it launched me into a career in technical analysis. And I started my career in San Francisco, working for a buy-side firm. It was actually Frank Cappiello, who's one of the Wall Street elves for those that are, my age or older. And I did hand chart point figures for them. Ultimately moved into a little bit of a different methodology, working under a couple of mentors over the course of my career, one of whom is Mike Hurley. We worked in San Francisco together, and I picked up a lot of great tools from him. And I found that they really resonated with just the way I think about the markets. And so that became very formative as well in terms of my methodology. Ended up moving back east and working primarily on the sell side. I worked at Morgan Stanley on their technical strategy team, picked up a couple of indicators there from Rick Benson-Yor, including the DeMark indicators, which I love. They're a big part of my process. And ultimately worked at MKM Partners, a big broker dealer here in Connecticut, and for BTIG as the last seat that I had before starting where I am now, which is Fairlead Strategies. So in 2018, I started my own firm to create a research consulting and subscription service. So I produce research. We're pretty prolific here at Fairlead Strategies. And then very recently in March of this year, I launched my own ETF.
Yeah, sounds a busy time for sure. And I know one of the ways that you and I first started talking, is little sidebar, is in starting businesses. We were starting businesses right about the same time. Admittedly, mine's not has been as successful, I'll say that. But it's still been, it was fun. I know that's one way we sort of found commonality initially, on top of working here at Dorsey Wright. And as you said, it's neat for me to hear the story, because there's some similarity there. Because when I was coming out of college, I sort of was scratching my head and trying to ponder how I wanted to think of the markets, or how I wanted to approach the market. And truthfully, I mean, for me, as we've heard with others, looking at the point and figure charting and learning relative strength from Dorsey Wright was a bit of a light bulb moment. And it's cool to even hear your story about it, that was somewhat similar. And truthfully, down the line, I think anybody who's worked here and been an intern and gone through the process sees that as well. So it's cool to hear the story for us, especially. Now it's we hear the cool story there. I guess now we get to dive into the fun stuff, quote unquote, in terms of talking about recent market action. Obviously, this week has been, Tuesday was defined by a large amount of volatility, especially to the downside. That was actually my first day back from vacation. So welcome back to vacation for me. But since then, we've seen a little bit of sideways action, but really in this month of September and sort of as we move towards the end of the third quarter, what have you been paying attention to? What have you been seeing?
Yeah, and I guess I would disagree in that you call it the fun stuff. It's not really been that fun lately, has it? It's
none whatsoever.
It's a difficult market environment. We all know that, and it's unlike anything we've seen really, at least in my work, since 2008. And of course, we're having to draw comparisons and in our indicators to that period. And unfortunately, what it suggests is that we've got more to come in terms of downside volatility. The comparisons that we can make also suggest that it's not going to end in a V bottom fashion, but rather some kind of drawn out process, potentially with support discovery and some hard retest perhaps of that support before we can really ensue on a meaningful, sort of recovery or bullish reversal. I do believe on sort of the good news side of things, I do believe that this is a bear market cycle within a secular bull trend. And yet I don't want to focus too much on that because I don't think that we have a great entry point at hand here. I think that with more weakness likely to come from a momentum perspective, I think we can, manage risk here of a deeper downdraft, try to be more sort of risk off in our exposure. It's really difficult to find long-term uptrends out there. There was something that I really valued with the point and figure charts is that the trends were so obvious and it really left no gray area. There was always a black and white takeaway, and it was a great way to identify breakouts and breakdowns. There was really no way to get caught up in the noise I found with these point and figure charts. Now we do sometimes get caught up in the noise, with a short to intermediate term focus, typically in our research. Right. But at our, sort of core, we are long-term investors. So we always let the long-term setup, it's looking at monthly bar charts, really tone what we're seeing short to intermediate term. And because the long-term momentum gauges, and by that we mean things like the monthly MACDs, the monthly stochastics, and moving averages. We also use the cloud model or Ichimoku. All of those things do point lower still. And I think that we just want to wait until we get some incremental improvement at a very minimum before we get back to that full exposure.
Well, and we're somewhat in a similar stance as well. That our long-term indicators are at least somewhat positive, but our near-term to intermediate-term indicators have just been all over the place for us, especially. I know looking at us, we have our 10-week indicator, which just measures those percentage of stocks that are trading above their 50-day moving average. In many ways, Tuesday's action turned out to be one of the largest drops that we've seen in those 10-week indicators going back to 1987. So there even on the short term was enough significance with a lot of our indicator change that we sort of took a step back and said, okay, the past couple of rallies have led to some opportunities for traders, but not really convinced us just yet to really be pushing the chips back on the table, if you will. And and it sounds like we're in somewhat similar position of waiting for that to occur, looking for those things to help us feel comfortable as we potentially look to shift our allocations back in and even get more aggressive in some fashion.
Yeah, I mean, it's a great measure of market breadth. And I know that Dorsey Wright services are valued highly for that. Also, I remember the bullish percentages on the sector front were really awesome. I look at now the percentage of stocks above their 50-day moving average is a very similar type of reading. And like you said, it fell dramatically this week to the point where I think it was down 40% just over the course of a couple of days, thereabouts. And yet you would think that generates a very oversold extreme. But in reality, the reading was 38% this morning. And in June, which was a really sort of a corrective low within the bear market cycle, it reached 2%. So we feel that there is more potential breadth contraction or essentially downside participation for the market. And that's not going to help. We also feel that there is the potential for downside leadership from the FANG complex or the mega caps of the market. We've seen a bit of a loss of relative strength there for the likes of Apple, Google, you name it. They really seem to be sort of losing their safe haven status within the market, just in relative strength terms. So we want to be respectful of that. And then also importantly, and I know you all do a lot of work on this too, the sector rotation work that we do, the sector relative strength work, which is really the stuff of our ETF, which is called the Fairlead Tactical Sector ETF, that it does show that risk off is appropriate. The defensive sectors of the market have been the best performers naturally year to date, and of course that includes in this environment energy, which has been just the stalwart outperformer for various reasons. But we want to stay with the relative strength trends, and they do not suggest that we're coming out of this bear market cycle yet.
Well, and that's somewhat similar to what we're seeing, especially with energy. I mean, energy has been our favorite sector at times, and then at times it's been the sector we might not like the most, depending on the day. We'll go with that. But it for us, what's been interesting too from that sector perspective is while we've seen somewhat laggard bounces especially out of tech and primarily consumer cyclical stocks here recently, it's not been enough so to really change our relative picture just yet to say that they're making a comeback, or the converse of that, and agreeing to somewhat to your point, we've not seen energy or staples or even utilities, interestingly enough for us, yield any of that strength either. In many ways, actually, this week, I believe utilities might be one of our, from a relative standpoint, one of the better looking sectors as far as looking at individual stock positions and even some ETFs within that space. But this is a tough time for momentum, as we've both probably talked to a few hundred or thousand people about, just because we're seeing that leadership remain stable. But right now, with the volatile swings in the market, it's presented itself with the challenge, especially being momentum followers. So it's not been an easy year by any means. And I think that's been a common theme we've heard from a lot of advisors that we speak to, is that 2022 is going to be one of those years that we sort of go back to and talk about is, do you remember this? Do you remember how this played out? So on and so forth. And I think this is going to be one of those years. And admittedly, I'll think of this as one of those podcasts that we look back and talk about some of the things that we were touching on, especially with how current relative strength leadership looks from our perspective as well. So it's nice to see in some ways, I'm sure for our clients, that we're agreeing in some fashion for sure. That's helpful for them. I mean, from there, is there any particular, I know you spoke of energy, but is there any particular sector that you've really been keeping an eye on recently because of either, potential laggard moves or anything like that?
Yeah, I mean, we do spend so much time on the sectors because we really believe it's the best way to outperform the major indices. So, and that's the goal of our ETF. The ticker is TACK, which it currently has exposure only to energy and to utilities on the sector front. And otherwise, it's in risk-off categories. So you can see how defensive the sector ETF has gotten. It also has positions in short-term treasuries, long-term treasuries, and gold. Because the sectors just aren't firing on all cylinders. We have a sophisticated model that judges momentum and relative strength and overbought, oversold inputs. And it's really only energy and utilities that is sort of qualifying there. Now, that doesn't mean we don't have pockets of strength that we try to leverage. In fact, we've identified those in, say, agricultural chemicals and clean energy and selected metals stocks. So you can find, some of the healthcare subsectors are doing pretty well. So you can find areas or spots of strength to take advantage of. But with our top-down top-down views being bearish, I think that, it just puts the odds, against you in some ways that they can really do very well. It's just a challenging tape. And when we look at utilities, for one, while the long-term uptrend there is very much intact, they're not the most exciting looking setup at this time. The momentum there is petering off, as you would expect it to, when the S&P 500 is down more than 4% in a day. That's the kind of environment that really no sector is going to be unaffected by that kind of weakness. So it really is challenging. In terms of downside leadership, we do tend to see technology and consumer discretionary, in part because of these mega caps and their footprints, underperform during weak tapes. And technology has started to manifest that underperformance. Discretionary, not as much, but we also suspect, I'm glad we agree on this too. It sounds like that discretionary will start to lose relative strength here. Not to say it's been amazing anyway, but just that it should start to make lower highs in relative strength terms. So we don't hold much hope for those sectors. We also look at things like growth versus value, and with technology likely to underperform, we'd expect that to impact that growth value relationship even more, where value should outperform, but it doesn't mean necessarily that value will be doing real well in absolute terms. So very difficult tape.
Right. Kind of one of those things that when explaining to folks relative strength, and especially on the downside, it's sort of like, standing at the ledge and dropping two rocks. And it's the situation of, one rock is going to hit the ground sooner. You're just holding the one that's taking a little bit longer to get down there, if you will. So it's just an analogy that I like to throw out there for folks is, explaining right now where we might be looking, even within certain sectors. The leadership may not look that fantastic right now. And it's been one of those years that, again, we noted earlier, it'll be a year that we come back and say, do you remember this about 2022 for sure? But it is interesting that you bring up the value growth relationship, because that is something that for us, we've truly talked about all year long and continued to monitor really closely. Here recently, it started as far as our scores go that we look at from a technical perspective, they've narrowed a little bit, but they're still fairly wide. So, we still see, at least from our perspective, that value is the leadership area, intermediate and long term. Growth has had a couple of good days, if you will, but as again, we've probably said a few thousand times, one day doesn't make a trend. So we're looking for more confirmation there.
Yeah, I'd be curious, how you all feel about international equity markets versus U.S. I feel like the long-term trends there are undeniably favoring the U.S., but I'm curious, because we focus on DeMark indicators to some degree, those are counter trend indications that show trend exhaustion. We are seeing some minor signs of downside exhaustion in the ratios that we track for international to the US. These are indications that hold value really over the next maybe few weeks, not few months necessarily. But are you seeing any signs of not capitulation, but just downside exhaustion international versus US?
For us, when looking at least the international realm, especially with a lot of the fund scores that our clients are familiar with, they range from a score of 0 being the lowest to 6 being the highest. So many international funds have been sub 2 all year long. And, even looking at the case of like EEM and EFA right now, they've been sub 1, so for us, there's, in a way, the scores can't go that much lower. Theoretically, they could hit 0, but they never do. So we're seeing that in a fashion that we've seen, on some of the international charts, 8 and 9 and 10 consecutive sell signals. We're now reaching further into oversold territory on our trading bands, even though they've already been in oversold territory. And from that score perspective, there's just not much more that they can give up. So in a way, we're kind of seeing that almost washed out that, is there really much lower that it could go for international equities? We've seen some blips out of China here and there, as well as India continues to really be the only bright spot within the international space as far as our research goes. But almost somewhat similar, kind of agreeing that we're seeing many of these scores so low that it's almost the extent that they can't go any lower. Now, that doesn't mean they can't be there for a while, but they can't go any lower. So in some way, we are seeing that sort of exhaustion out of international equity, that they've kind of just been beaten up so much that we don't really see how much lower they can go from our scoring perspective. And especially as far as looking at a lot of charts, I mean, it's hard to see a chart that has 10 consecutive or 8 consecutive sell signals on it. That's uncommon even for a volatile name. So
yeah, I would imagine. So, I mean, do you wait in that situation for, say, and I might not be saying this exactly right, but movement from the 1 to the 2? Would that be what would be the compelling shift? Would you wait for that shift?
Somewhat, yes. I mean, and it would be a sign of at least improvement, which is our positive and our near-term piece. From that scoring perspective, a lot of times for us, the acceptable score is once it moves above 3 into that 3 to 6 zone. And that's when it's, for long-term buyers, we think it's good to go, generally speaking. But even then, looking for that score improvement is what we're watching for.
Right.
And we have a measure for that.
Momentum.
Or direction. Right. Looking for it to swing back in our favor, if you will. And we've not seen that yet. Like I said, we've seen China had a couple of blips over the summer where it jumped up in score and then fell back below pretty quickly. Really, the only group that we've seen that sustained leadership out of is India, from our perspective. Not much else to be found within the international space, but it doesn't mean we haven't had conversations, especially within the office or even with clients, of kind of, is this for domestic? Are we seeing international so washed out? Are we at a potential paradigm shift? And obviously, no one knows, but it does present a lot of things for us to continue to monitor and watch for sure.
For sure. Yeah. I mean, we watch the same things. We're just looking for long-term turns at this point to take advantage of. And meanwhile, we're, trying to focus on idea generation. And it's very difficult to find these long-term uptrends. So it forces us to get somewhat creative. We are recommending at times inverse ETFs if we have to, or, looking for something that would be more of a commodity related play, something that, is right outside. A periphery
for a lot of our clients this year.
That's right. So we're getting creative with that. And then otherwise, just trying to manage risk in terms of the short-term moves in the major indices, trying to help folks know when it might be wise to put on hedges or to temporarily remove the hedges, because we know that there always, for most of our clients, there has to be some core equity exposure. They don't have the flexibility necessarily to go down to such a heavy cash position or what have you. So they have to manage risk in other ways. So we've been trying to help a handful through that type of environment, still provide some ideas that at least have a bit of conviction behind them. Even the consumer staples sector, for the most part, is in a range, being still an outperformer in this environment, but really not in a long-term uptrend anymore. But you can find some spots of strength there, some of the, grocery stores or things of that nature that do tend to outperform in these weaker environments. And until we get out of it and we can get more aggressively high growth again, I think we just, hold that patience. I mean, try to just, sit on our hands to some degree and wait for the market to turn.
Well, and that's the big thing that I feel like a message that we've conveyed to a lot of our clients, especially after we saw the rally this week and then, following Tuesday's action. We definitely fielded a lot of calls of folks asking, what do I go ahead and buy here? What do I look to do next? And in many ways, we conveyed that message to quite a few that this might be one of those days we just kind of sit on our hands and, wait from there and see how it plays out. But also, this has been a year for, I think I've used the phrase diamonds in the rough more this year than I ever had in the past, describing potential stock ideas. So I feel what you're saying down there. But Katie, as always, great seeing you. Don't want to take too much of your time. I know you're incredibly busy. We appreciate you coming on today. And again, we'll hope to have you on sometime again soon. So thanks for joining us again this week. And And thank you, Katie, for coming on. So thanks for joining us this week. We appreciate everybody coming on. Feel free to tune in next week for what we'll look to discuss that's happened over this week's action.